Good morning. Thank you for joining session 3 of our board series, Revolutionizing Compliance and Regulatory Reporting, from burden to competitive architecture. Over the next 20 minutes, I'm going to show you something that most fiduciary firms are just beginning to understand. Compliance is no longer administrative overhead. It has become the foundation of competitive advantage. Over the past months, 3 regulatory shifts have converged to create what we call an architectural inflection point. CRS 2.0 and CARF now mandate machine-readable reporting by 2027. The EU AI Act requires explainability and auditability for any AI deployed in financial decision-making. And the Financial Stability Board expects continuous real-time monitoring of AI systems and third-party dependencies. These are not incremental changes. They represent a fundamental shift from document-based compliance to data-integrated compliance. In this session, you will see, first, why traditional approaches to compliance are structurally failing, even when firms add headcount, consultants, or technology. Second, how properly governed AI creates what we call continuous compliance, a self-verifying system built on data integrity, intelligent automation, and board-level governance. Third, the verified evidence from the Bank for International Settlements, the US Government Accountability Office, and the Bank of England, showing that AI-enabled compliance reduces reporting cycles by 30% and errors by 40%. Fourth, a real fiduciary case study, TMF Group's audited results showing 2,062 processes automated and 371,000 manual hours eliminated. And finally, the 4 CEO mindsets required to lead this transformation in your organization. Every statement you'll hear today is cited. Every data point is verified. Every source is linked in your reference materials. This is not theory. This is documented practice at leading fiduciary institutions worldwide. By the end of this session, you will have a clear framework for moving from reactive compliance to regulator-ready architecture, and you will understand why firms that begin this transition over the next 12 months will hold structural advantage for the next decade. Let's begin. Regulation has become code. CRS 2.0, CARF, and the EU AI Act no longer treat transparency as paperwork. They require it to be engineered into the system itself. For fiduciary firms, this marks a structural turning point. Over the next 14 months, advantage will belong to those who achieve operational clarity, compliance at scale, and regulator-ready architecture. Fiducia Corp's Market Intelligence Report 2025 calls this the quiet race toward continuous compliance infrastructure. But before we discuss the solution, let's be honest about where most firms are today. Every trustee and family office CEO feels the same friction. Fragmented data across jurisdictions, manual reconciliations that consume weeks, and regulatory fatigue that erodes strategic capacity. Many have responded by adding compliance officers, yet turnaround times remain unchanged. Others have hired consultants who deliver documents but not resilience. They respond to crises but rarely prevent them. Still others have deployed point solutions. One system for KYC, another for CRS, a third for internal audit. None speak to each other. Risk simply migrates. The US Treasury's 2024 report on artificial intelligence in financial services found that legacy processes struggle to monitor AI-driven financial activity in real time. That single sentence defines our industry's challenge. Because the problem is not manpower, it is architecture. Manual checklists create comfort without control. They generate activity, not assurance. Consultants deliver compliance theater, impressive presentations that satisfy auditors momentarily but fail to build institutional resilience. And siloed technology creates what I call compliance Jenga, a fragile tower where removing one piece threatens the entire structure. Have you tried adding more compliance staff? The bottleneck just moved. Have you brought in Big Four consultants? They left you with a 200-page document no one reads. Have you bought the latest RegTech tool? It doesn't talk to your core systems. These approaches fail because they treat symptoms, not architecture. 3 converging forces now rewrite the rules of fiduciary practice. First, the OECD's CRS 2.0 and crypto asset reporting framework. By 2027, narrative PDFs and manual spreadsheets will no longer suffice. Regulators demand machine-readable, structured data that can be validated automatically. This is not incremental change. It is a fundamental shift from document submission to data integration. Second, the EU AI Act, Regulation 2024-1680. This legislation requires financial institutions deploying AI to ensure explainability, auditability, and human oversight. AI systems must document decisions, flag anomalies, and preserve complete audit trails. More importantly, they must do so in ways that regulators can verify independently. Third, the Financial Stability Board's continuous monitoring mandate. The FSB now expects real-time visibility into AI use and third-party dependencies. Regulators want to see risk as it emerges, not retrospectively after damage occurs. Together, these frameworks signal one unifying principle: compliance must be auditable by design, not assembled by deadline. Together, these frameworks signal one unifying principle: compliance must be auditable by design, not assembled by deadline. Properly governed AI transforms compliance from cost center to competitive infrastructure. Let me share the verified evidence. The Bank for International Settlements published groundbreaking research in December 2024, showing that AI-enabled compliance systems shortened reporting cycles by approximately 30% and reduced error rates by roughly 40%. But automation here is not about speed. It is about veracity. Think about what AI actually does in a compliance context. It detects anomalies in real time, not after the fact, but as transactions flow through your systems. It builds end-to-end data lineage. Every data point knows its origin, its transformation history, and its destination. It creates a living audit trail, each step time-stamped, reviewable, and explainable. This is what we call continuous compliance, a system that self-verifies. Let me break down how this architecture actually functions. Layer 1, data integrity. This is your foundation. Unified pipelines with complete provenance tracking. Every data point in your system must be able to answer 3 questions. Where did I come from? How was I transformed? Where am I going? Fragmentation is eliminated at the source. Data governance becomes embedded, not bolted on. Most firms fail here because they treat data as a technical problem. It is actually a governance problem with technical solutions. Layer 2, intelligence. This is where AI operates. These systems monitor patterns, draft reports, and flag exceptions. But, and this is critical, they preserve human override rights at every decision point. IBM Consulting's 2025 research calls this supervised autonomy. The AI proposes, humans approve. This layer is not about replacing human judgment. It is about amplifying it. Your compliance team stops drowning in false positives and starts focusing on genuine risks. Layer 3, governance. This is where boards and senior management maintain control. You define risk thresholds. You audit AI outputs. You approve final submissions. Technology serves oversight. It does not replace it. This layer ensures that even as AI automates processes, accountability remains firmly human. Now let's examine the evidence that this approach actually works in the real world. The US Government Accountability Office published a comprehensive study in May 2025 showing that AI-enabled AML tools can significantly reduce false positive alerts. Legacy rule-based systems generate alert fatigue. The vast majority of alerts prove to be false positives, consuming most analyst time on investigations that lead nowhere. AI refines detection precision. Your team focuses on genuine suspicious activity. The Bank for International Settlements documents financial institutions already using AI for fraud detection, regulatory reporting, and supervisory analytics. This is not future speculation. It is current practice at leading institutions. The Bank of England and Financial Conduct Authority surveyed 118 financial firms in November 2024. Their findings: 75% already use AI, and 32% plan to apply it specifically to regulatory compliance and reporting within the next cycle. These are operational systems deployed in institutions managing trillions in combined assets under administration, and 32% plan to apply it specifically to regulatory compliance and reporting within the next cycle. These are operational systems deployed in institutions managing trillions in combined assets under administration. Let me give you a concrete example from the fiduciary sector. TMF Group operates across 87 jurisdictions, providing corporate and fiduciary services. Their 2024 annual report, audited and public, shows they automated 2,162 processes and eliminated 371,000 hours of manual work through AI-driven digitization. Think about what that means operationally. Reporting cycles that once took weeks now complete in days, with precision, with traceability, with full audit trails. Their compliance team shifted from reactive firefighting to strategic oversight, and their clients received faster, more accurate service while regulatory risk actually decreased. This is the economic model. AI does not just reduce cost, it fundamentally improves quality and reliability. The numbers are audited, the transformation is documented, the results are replicable. The regulatory expectations are now explicit and enforceable. The EU AI Act, Regulation EU 2024-1689, requires that high-risk AI systems, including those used in credit decisions and compliance functions, must meet 3 non-negotiable standards. Explainability: every decision must be traceable to specific inputs and logic. Auditability: complete documentation of model design, data sources, and deployment decisions. Logging: full records of all automated decisions, human overrides, and system outputs. The penalties for non-compliance are severe, up to 35 million euros, or 7% of worldwide annual turnover, whichever is higher. For fiduciary firms operating across European and European adjacent jurisdictions, Switzerland, Luxembourg, Channel Islands, and those serving European clients, this is not guidance. It is law. The Bank for International Settlements documents in production use of AI for AML, CFT, regulatory reporting, and supervisory analytics, and stresses board-level expectations for explainability, auditability, and logging. This represents global regulatory convergence around a single standard, and the Bank of England and FCA provide market validation. Their November 2024 survey of 118 financial firms found that 75% already use AI and 32% plan to extend AI specifically into regulatory compliance and reporting within the next 3 years. The message is unambiguous. Governance cannot lag technology. Boards that wait for regulatory clarity that exceeds what already exists are choosing structural disadvantage. So how do you actually lead this transformation? Through 4 disciplined mindsets that operate simultaneously. Visionary mode. The seer. Hold one North Star intention. Regulator ready by design. Not compliant by effort. Compliant by structure. Every architectural decision must answer a single question. Does this move us toward built-in compliance that satisfies the EU AI Act, BIS standards, and cross-jurisdictional expectations simultaneously? This is not about meeting minimum requirements. It is about engineering systems that make compliance inevitable. Integrator mode. The belief aligner. Embed the truth that compliance is capital preservation. Make it visceral, not intellectual. Create a daily ritual. Review your data integrity score first thing each morning, not as a compliance metric, as a performance metric. When leadership treats data quality as equivalent to revenue in their personal attention, the organization follows. This shifts compliance from the compliance department's problem to the executive team's competitive advantage. Architect mode, the pattern designer. Focus ruthlessly on three priorities: data governance, AI oversight, and continuous audit loops. Everything else is secondary. Set clear boundaries. What AI may automate, what requires human review, what boards must approve. These boundaries are not constraints. They are the rails that allow speed. Establish weekly cadence. Define simple, clear metrics. Data lineage completeness, audit trail integrity, explainability score. Complexity is the enemy of execution. Simplicity is the path to scale. Craftsperson mode, the precision executor. Implement standard operating procedures for every AI-enabled process. Document not just what the system does, but why decisions were made to configure it that way. Conduct post-submission debriefs after every regulatory filing. What worked? What broke? What did we learn? Precision eliminates doubt. Documentation eliminates regulatory risk. SOPs ensure repeatability. This is where compliance becomes operational muscle memory rather than heroic effort. When these four modes operate together, something fundamental shifts. The boardroom moves from defensive compliance, how do we avoid penalties, to strategic mastery, how do we use compliance architecture as competitive differentiation? You stop reacting to regulatory changes and start anticipating them. You stop viewing AI governance as cost and start recognizing it as moat. At Fiducia Corp, we address the three barriers that prevent most firms from achieving this transformation. First, data security and privacy. We build encrypted, compartmentalized data environments that meet GDPR, CRS, and jurisdictional requirements simultaneously. Second, ethical and regulatory risk. Our AI governance frameworks ensure explainability, human oversight, and regulator-ready audit trails from day one. Third, integration with existing systems. We design interoperability layers that connect legacy platforms without requiring full replacement. Here is what few are saying publicly, but everyone knows privately. Compliance is becoming a competitive moat. Firms that achieve regulator-ready architecture will win client mandates that others cannot even bid on. Sophisticated clients now ask, show me your data governance framework. Explain your AI oversight. Demonstrate your audit trail capabilities. Those who cannot answer clearly lose the opportunity. This is not compliance as cost. This is compliance as strategic advantage. The transition from reactive compliance to regulator-ready architecture requires clarity on your current state, a structured roadmap, and experienced guidance. That is exactly what our board-level diagnostic provides. Schedule your diagnostic via fiduciacorp.com contact or connect with us on LinkedIn at Fiducia Corp. For 30 years, compliance has been viewed as a burden, necessary but unproductive overhead. That paradigm is ending. The firms that recognize compliance as architecture will lead the next decade. Those that continue treating it as administration will struggle to survive. The choice is not whether to transform. It is whether to lead the transformation or be disrupted by it. Calm is compliance. Clarity is control. Architecture is advantage. Thank you.